Welcome everyone, and thank you for joining our webinar. Today's topic is investment in IPM, challenges and opportunities. A few things to keep in mind. All attendee lines are muted throughout the presentation. At the end of the presentation, there will be time for questions. You can ask questions by typing within the Q&A section, which is located in the control bar. That is most likely located on the top or bottom of your screen. This webinar will be recorded and it will be available next week. Today's speakers include Hal Katz, partner at Husch Blackwell, and Abe Mboj, who's a senior analyst at Provident Healthcare Partners. I will now turn it over to Abe to give a brief introduction on Provident.
Hi everyone, again this is Abe Mboj with Provident Healthcare Partners. Really appreciate everyone dialing in today. Just to kind of kick things off, we'll give you a little bit of background on our firm, and Hal will give a little background on Husch Blackwell as well. So Provident Healthcare Partners, we're a healthcare-focused investment banking firm, specifically in healthcare services. So we don't do biotech or med device transactions, everything that's healthcare as a service as we know it. We've done about 129 deals since our existence over about 21 years. Most recently, we've created a reputation as one of the most active investment banks within physician services. So we've done 49 physician transactions since 2014. Work on about 12 to 15 deals per year, and we have about 24 professionals in Boston and Los Angeles, so kind of coast to coast coverage. Within pain management, you can see above, we've done deals in a number of different specialties of the physician world, but within pain management, it's actually been one of our most active sectors. So we've done about 11 transactions in total within the pain segment, representing groups like National Spine and Pain Centers through their original recapitalization with Sentinel Capital Partners. But have a strong track record in the pain management industry, strong track record in the physician industry in the broader sense. And that's lended us to having experience dealing with large and varied shareholder bases, different shareholder motivations, and all of the unique aspects and components that go into advising through physician merger and acquisition transactions. And now Hal will give a little bit of background at Husch Blackwell.
Thanks, Abe. Again, my name is Hal Katz. I'm a partner in the Austin, Texas office of Husch Blackwell. I'm a mergers and acquisition lawyer focused on healthcare and life sciences. Husch Blackwell is a national law firm with 18 offices across the country. Unlike most law firms, we're organized around 6 key industries. Our healthcare and life sciences industry group is the 7th largest in the country. With this structure, it means our corporate, labor and employment, real estate, and tax lawyers all focus on and have familiarity with healthcare and life sciences industry issues and practices. With our focus, this enables us to understand what our clients face on a day-to-day basis, and our guidance also takes into consideration what is trending in the industry and in a particular geographic market. Our deal teams are all comprised of lawyers with expertise in M&A, healthcare regulatory, managed care, labor and employment, real estate, tax, and antitrust, all the important issues that arise on a deal, especially in the private equity healthcare space. We utilize legal project management, which is a business tool that allows us to be more effective and efficient in managing transactions. We've also recently embraced artificial intelligence to help with efficiencies and the legal spend. This is most often on the deal side used to assist us in due diligence review. With that introduction, I'll turn it over to Provident to lead us into our presentation for today.
Great. So before we kind of talk a little bit about the transaction activity and the transaction opportunities within pain management, want to just set the context and stage for why we're seeing so much interest and investment into the sector. So one, I think it started with kind of low interest rates historically. So when we go through the chart on the next slide, you'll see a lot of the activity culminated with kind of a low interest rate period and call it the late 2010s and early 2010s, and has continued to accelerate from an investment standpoint since that point. So the debt markets have been favorable within kind of the broader sense of physician services and M&A as a whole. As you see interest rates rise, obviously across the debt capital markets now with the Fed, everyone's eyes on what the Fed plans to do with rates. As those raise, it tends to have an inverse impact on the cash at close. But going down to kind of the chart on the bottom left here, you can see that the healthcare private equity deal flow remains very substantial throughout the latter half of 2018 and into 2019. And really, as you think about interest rates rising, sure, that makes transactions a bit more expensive, right? Because if they're financing them with debt, the cost of that debt becomes more expensive as interest rates increases. But we've seen record year-over-year fund flows in terms of new dollars flowing into the hands of private equity firms. So as you have a lot of capital coming to these private equity firms, they're putting that capital to work within all of the physician sectors and healthcare sector. And so you see that as a little bit of an offset to kind of rising interest rates, and that we feel will help kind of stabilize multiples, even though historically as interest rates have gone up, multiples have come down. I think just from our transactions that we've worked on, we still see very strong valuations. And so with pain management specifically, it's a bit of an interesting market. It's heavily fragmented, so very similar dynamic to a lot of other physician specialties. It was one of the original kind of physician services segments to undergo consolidation with one of the first transactions with Excellier Partners and Advanced Pain Management in 2008. And then the second transaction coming actually in 2011 with National Spine and Pain Centers, recapitalization with Sentinel Capital Partners. But the reality is the vast majority of the pain management market out there operates with less than probably 10 clinical providers within each practice. And so there's an opportunity for large organizations that have infrastructure and scale to go out there and relieve some of the administrative burden that a lot of these smaller organizations face as they are transitioning towards medicine in a value-based environment, having to make investments in infrastructure and information technology and advanced billing capabilities. And so if you're a platform that can leverage what you've already created, you can be a solution for a lot of smaller groups out there. And so that's been one of the driving factors of the consolidation engine within pain management. I think specifically to pain from just a market dynamic standpoint, going back to having the majority of practices operating with less than 10 clinical providers, there's a real supply and demand imbalance out there in the market for what we would call platform caliber or very, very high quality from an investor standpoint practices. And so as you think about transactions in this space, that scarcity value really we've seen drive a lot of value for pain organizations, because when private equity firms understand that there's not a lot of what we would call, again, platform caliber organizations that are out there in the market. And so when an opportunity to partner with one comes available, they tend to be very aggressive on price. And so in the bottom right corner here, you can see kind of some of the largest pain management organizations in the country. As you can see, National Spine and Pain Centers, they did their first transaction with Sentinel Capital Partners in 2011, which we advised them through. And subsequently were recapitalized again in 2017 by another private equity firm called Avista Capital Partners, after having grown from originally about 9 locations in the state of Maryland to 8 up and down the kind of mid-Atlantic corridor. Prospera Pain Care did their first private equity recapitalization with enhanced equity funds in 2013. Cure Smart Pain Management, recently it recently was known as Cure Pain Management, just made a large acquisition of Smart Pain kind of in Maryland and becoming one of the larger dominant players in the market. Is a portfolio company of New Harbor Capital as of 2015. Advanced Pain Management, as I mentioned, this was actually the first group to take on private equity capital in the pain management space with a transaction with Excellier Partners in 2008. Subsequently did a transaction in 2011 with Chicago Growth Partners and have continued to see a lot of success for that organization. And Alliance Spine and Pain Centers, based out of Georgia, as a portfolio company of ICV Capital Partners as of 2013. And so moving on, we'll walk through some of the transaction dynamics within the space, so you can kind of see how this activity has really ramped up over time. So one transaction wasn't featured on here just in 2008 with Advanced Pain Management and Excellier. That was kind of the first deal, but really in 2011 is where the activity started to explode. And so These transactions are categorized. You can see that the kind of navy is what we would call a platform deal. That's either a private equity firm, making an investment into a new platform practice, or an existing PE-backed group, or already existing platform purchasing into a new kind of region of the market. So maybe moving from Texas to Florida, or Florida to Maryland, or something of that sort. We would characterize that as a platform as well. And then kind of public add-ons. So as you think about organizations that are partnering with pain practices out there, groups like Surgery Partners or AmSurg or SCA, very large national organizations, they have an interest in pain management as well, and there's a few of those transactions. But beginning in 2011, you see kind of two platforms, come into existence. So Chicago Growth recapitalizing Advanced Pain Management for the second time, and Sentinel recapitalizing National Spine and Pain Centers for the first time, as well as in 2012, in August, you had Enhanced Equity Funds partner with Prospera Pain Care. And so what you'll see is after those three, initial platform deals, I think that the timeline kind of speaks for itself in terms of the explosion of activity. And really what drives that is new platforms coming into the market, right? Because as these platforms get created, their goal is to grow aggressively, and they want to partner with groups out there in the market and find add-on acquisitions and opportunities to expand the organization. And so interestingly enough, within pain management, there was some kind of hesitance, amongst the private equity community to put a lot of additional capital to work within the space following some reimbursement cuts and call it the early teens, 2013, 2012, 2014. And so a lot of these groups were able to make a lot of acquisitions, but we didn't see a whole lot of new platform investments. And so as of recent, you can see moving into kind of 2017, 2018, just you can see here beginning in kind of June with Vista Capital Partners recapitalizing National Spine and Pain Centers for the second time after their successful partnership with Sentinel Capital Partners, as well as New State Capital Partners and Capital Pain Institute, Common View Capital recapitalizing Central Texas Pain and Pain Specialists of Austin, which is another client of ours. And then last year in 2018, American Discovery Capital recapitalizing Center for Pain Management, Next Phase Capital recapitalizing Gulf Coast Pain Institute, which is now known as Clearway Pain Solutions, Spindletop Capital recapitalizing Tri-City Pain Associates. And so, and also in January of this year, Georgia Pain and Wellness in a recapitalization with Fulcrum Equity Partners. And so we've had this sudden explosion of all these new platforms come onto the market, and they're going to be looking to grow aggressively. So our expectation would be, just looking at this timeline, that you're going to see a lot more of these add-on acquisition opportunities continue to ramp up, just as it did in 2011, probably at a much greater clip, because there's honestly a lot more platforms out there than there were in 2011. So as we go forward, just in review of this kind of chart, we would expect a lot more activity in the pain space. And so moving on, we'll talk about kind of the structure and strategies behind a lot of these transactions. So here we have kind of three buckets. So private equity backed company, or public acquirer. And so as you think about private equity, what is private equity? Private equity are firms that are investment funds that are out there that are raising, capital to then make investments in organizations within the lower middle market of healthcare. And the idea is that they want to partner with a platform organization, and then look to grow that organization over the next 3 to 5 to 7 years, leveraging their capital and relationships and the expertise that they have from having done this before, as well as use that to complete acquisitions and grow the platform. So the structure of those transactions is generally the original shareholders of the organization will sell a majority stake of the equity in the business, anywhere from 60 to 80% to the private equity firm, and they'll obviously maintain about 20 to 40%. And the idea is they want to create a 3 to 5 times return on those equity dollars in that, call it 3 to 5 year window. So below, you can kind of see a few really active healthcare private equity firms: Fraser Healthcare Partners, HIG Capital, Varsity Healthcare Partners, and WAD Capital. With the resurgence we've seen within pain management, there's a lot of interest from the private equity community to find additional platforms. So listed 4 here, but there's 30 to 40 names that you could approach that would have an interest in partnering with pain management organizations and growing them. Private equity backed organizations, a little different in that there are groups that have already gone through a private equity transaction. And so they're out there looking for either regional platforms or add-on acquisitions, most notably, again, National Spine and Pain Centers, who's currently a portfolio of Vista Capital Partners. And so the opportunity there is, you take a little bit less risk in that you're not forming the initial platform, but you're joining, you're potentially joining an organization that has resources kind of already in place, leveraging the existing platform that's there. And there's still an opportunity to roll some equity into the established platform that will continue to appreciate as the organization grows. And then with public acquirers, groups like Surgery Partners, which we represented a group that was acquired by Surgery Partners last year, Pain Management Associates, based out of Orange County, California. But public organizations bring obviously vast resources to the table, an opportunity to drive a lot of synergies, and these tend to be the most common transactions for individuals or management teams that are looking for a lot more liquidity out of the transaction, perhaps some sort of exit strategy or transition plan. But there's an opportunity to have put options post-closing or continue some distributions as you go forward, looking towards future liquidity events. Option 1 and Option 2 are much more focused on equity value growth. And so you're kind of looking forward to a second, exit or transaction, whereas these public transactions tend to be on the front end, a lot of times 100% buyouts. And so moving on to the next slide. So what are the qualities of an attractive platform, or what are these investors looking for when they're looking to partner with organizations? These are a couple of the important things that we would highlight. There's obviously more that goes into it than this, but low revenue concentration risk. Is the revenue diversified amongst the provider base and amongst service lines? Does the practice have diverse service lines? Within pain, this can be especially tricky because sometimes groups will generate a lot of their profitability from their lab or from a pharmacy. And so, within pain management, there's been some volatility within the reimbursement of those services. So private equity firms tend to value those differently than call it just the pure kind of procedural injection revenue of the business. Does it have a strong management team? Is the management team capable of expanding the organization and managing it as it doubles and triples in size? EBITDA, so does it have a sizable EBITDA base to support future growth? And EBITDA is earnings before interest, taxes, depreciation, and amortization. This is the basis of all the transactions and what the multiple ultimately gets applied to create the purchase price or enterprise value. But EBITDA is used to value these transactions because it's a proxy for the cash flow of the organization. And private equity firms want to leverage that cash flow to use it to reinvest in the business, reinvest in the infrastructure, use it to finance additional acquisitions. And so the more EBITDA that a practice has, you tend to see a correlation to the higher the multiple that either a private equity firm or private equity-backed platform is willing to pay, because they can use that cash flow to do more, obviously, the more cash flow that exists. Can't stress this enough, robust compliance protocols. So within pain management, it's no secret that there's been a lot of compliance issues amongst groups and practices out there. So as groups are looking to partner with pain management practices, the compliance protocols and compliance review becomes one of the most important things that a practice will undergo in diligence. And we actually spend a lot of time with our clients up front, making sure we're highlighting the compliance procedures as the organization goes to market, because that's a very important aspect of all these transactions and something that's looked at under a microscope. Investment in facilities and equipment. Obviously, as you look to expand the organization, you want to have the caliber of facilities and the equipment that can be used to expand the organization, and with the top quality EMR and things like that. So as you scale, your practice can support kind of future growth. Because if you remember, the whole play here is to go out and partner with smaller groups that maybe don't have infrastructure, maybe don't have the necessary investments in IT and infrastructure. And so if you have those investments in place, the private equity firm or group you're partnering with can leverage those, and that helps obviously increase the multiple that they want to pay on the front end to partner with the organization. So it's important to make those investments. Along those similar lines, a very strong internal infrastructure, obviously important as you think about growth. You want to have kind of centralized billing, centralized finance, IT, HR functions, everything that the organizations you're aiming to partner with would need to operate their practices in best practices from both a business and clinical standpoint. A diversity of payer mix, so not obviously having a concentration of collections from a single payer, tending to be more favorable the more commercial it is, obviously, so that's always important. And then geographic density, so a lot of times platforms initially have a pretty strong density within a single geography. So as I referenced, National Spine and Pain Centers, at the time we represented them in 2011, they had about 9 locations in the state of Maryland, the largest in the state of Maryland, but it was just in the state of Maryland. But controlling that market, they were able to leverage that model and enter into other markets. So fast forward today, they're in 8 different states, kind of down to North Carolina, all the way up to New York City. And so, building geographic density in each region was important for them. And the groups that they partnered with along the way each had geographic density in each of those respective regions. And so moving on here, we'll talk about some of the important transaction considerations for shareholders. So, what are the shareholder motivations? What type of transaction? These are all things you want to consider as you think about a process or a transaction and timing towards exploring it. Shareholder motivations, again, what type of transaction makes the most sense for the shareholders? Is it private equity? Is it strategic? Are you looking at a transaction as some sort of exit plan from the business, or are you perhaps younger or looking to aggressively grow the business and you think private equity capital can be a solution to doing that? What are the growth objectives of the organization? I think one thing we've learned in across 11 pain transactions is every group has different motivations for what they want to do and how they want to grow. Are there de novo opportunities available? Are there acquisition opportunities that the group can leverage? Are there relationships already in place with groups that want to join your organization, but maybe you don't have the capital to do so? Those are the types of things you want to be thinking through. Corporate infrastructure, do you, along the lines of kind of, what makes a good platform, what sort of corporate infrastructure does the practice have, and what are the things, and not every deal, trust me, has all of the pieces in place at the time of doing a transaction or at the time of raising private equity capital, but it's important to think through, what can we leverage within our organization to benefit other groups out there in our market, and what are we doing better than anybody else that we can use to bring value to other groups. Time horizon, how long do the shareholders expect to be involved with the business? As we had mentioned, the standard timeline for a private equity transaction is, call it 3 to 5 years, maybe 7 on the higher end. And so, do you expect to see yourself staying through 2 transactions, 3 transactions? Do you want to, phase out of the business almost immediately? Tends to be more of a strategic public type transaction in those cases. But thinking through your time horizon as shareholders is obviously very important as you think about the planning phase. Strength of the management team. Does the management team have the bandwidth or capacity to undertake further expansion of the organization? As the organization doubles and triples in size, will the management team be able to manage that size and scale? What are the additional investments that we may need to make to be able to do so? Also very important. And then risk tolerance. So, how many chips would the shareholders like to take off the table, if any at all? Obviously you can continue to hold your business and grow it. If you go the private equity route, you can roll a very substantial amount of equity into the go forward entity. And that's you're essentially taking some chips on the table, but doubling down with a big stake of equity. Or would you like to sell a pretty substantial chunk, maybe 80-90% of the business, and keep a small piece, but take a lot of chips off the table? So these are all kind of things that we can't answer for you as an advisor. We can kind of guide your thinking along them, but certainly things we want our clients thinking about as they think about pursuing a transaction process. So moving on. And so lastly here, just again, preparing for a transaction process, there's kind of 3 buckets that we advise our clients to consider as they think about the timing and how you position the organization during that process. And so there's strategic, operational, and financial. So from a strategic standpoint, what are the key, and these are all things you have to think through, right? What are the key growth opportunities that are available to the organization that will be attractive to an investor? So what are the new ancillary service lines that the pain group could launch? Again, as we talked about in the last slide, what are the relationships we can leverage that could turn into potential acquisition opportunities, things like that, and we want to highlight that obviously as you consider that during the process. are all of the shareholders on board for a transaction? It's very important that everyone's kind of on the same page and well educated with respect to the transaction, because in a physician business, the shareholders tend to be the physicians 99% of the time, and you want everyone on board because they're the real assets, the real revenue generators of the business, and so need to make sure that they're on board for a transaction. Also along those lines, kind of a step further from shareholders, stakeholders, all of the associate physicians and key management team members on board for a transaction as well. We've been in a lot of situations where you really have to have buy-in from the associate physicians, because a lot of times they can be a very meaningful portion of the productivity of the practice, as well as key management team members who have helped build the practice over a substantial period of time. And so, are they on board for a transaction? It's very important to have them on board. From an operational standpoint, does the team have the bandwidth to evaluate partners in an orderly and efficient format through an organized process? And really that's where we kind of come in and help run that process, so that we're making sure you are getting the best offers that are on the table, finding the right partner to grow your business, and obviously driving competition. Are the corporate documents, leases, things like payer contracts, are those readily accessible? Because as you find a partner, transaction partner, move into the due diligence phase, they're going to go through everything in the business with a fine-tooth comb, and so they'll want to you want to have easy access to all of those documents as you pull them. And along those similar lines, can the organization pull data from the from the EMR system at the unit economic level? Because everyone's going to want to evaluate the trends of the business from a billing data standpoint, from a CPT code level standpoint. And so you want to understand those trends from an operational and business standpoint. And we work with our clients to kind of prepare that billing data ahead of going to market, but something that all the private equity firms and anyone who's doing these transactions will evaluate very thoroughly. And then financial consideration. Are all of the financials organized appropriately, and are you able to evaluate kind of trends by location and service line? Obviously, you want to understand the trends of the business from that standpoint. Key add backs. So all the transactions are done again on kind of EBITDA, but there are adjustments because we want to understand what the true cash flow of the business is. So a lot of times there may be a legal settlement or something like that, or a consulting project. We want to add those types of things back to the earnings of the business, because while they may have impacted the business in 2018, they're not expected to impact it in 2019. And so want to make sure we're representing the true cash flow, and thinking through that ahead of going to market is very important. And then the impact of obviously converting from cash basis to accrual accounting. So all of the transactions are done on an accrual basis, and there can be some differences in the earnings and net income and EBITDA when you make that switch from cash to accrual. So with that, I will turn it over to Hal to kind of walk through everything from a legal standpoint.
Thanks, Abe. My portion of the presentation will first pick up where Abe left off on the value of spending time preparing for a transaction and how to prepare, the first legal steps when exploring a transaction, what to expect in the due diligence process, a review of the more material regulatory issues that can impact a transaction, and then finally, deal points that may be a little more unique to the healthcare industry. On the next slide, I will start with the preparation side. Of course, the first step in preparation is making sure that you've got a strong deal team. That's an internal deal team, an external deal team. Internally, it will be designating individuals who need to have access to the fact that a deal is being explored, and who will have access to this information and responsibility for collecting the information that will be necessary for negotiating a deal. And then secondly, the external team will include an investment banker and lawyers who have experience with private equity transactions in the healthcare space specifically. The team will definitely save money and avoid losing a deal if they're experienced in this area. Now, as for preparation, similar to buying a house, there will be an inspection process. And just like when selling a house, the seller should spend time getting the house ready for sale, similar to some of the issues that Abe laid out for those reasons. These steps are going to reduce the risk of spooking an investor, allowing an investor to use a surprise as an opportunity to negotiate more favorable terms, or even jeopardizing a transaction altogether. The things that I recommend as preparation include, as also Abe said, finding but also updating corporate documents like operating agreements, bylaws, minutes, and redemption agreements used to buy out former partners or owners of the practice. Going through the list of payables and payer sources and pulling together those agreements associated with payables and payers. It's always a kind of a cheat sheet of knowing who you might have an agreement with by running through those lists. Conducting a lien search to confirm creditor liens that that have been filed, to confirm that they are current, they're correct. Oftentimes we'll find expired liens or liens that we didn't know about that need to be removed and should be removed before engaging in this process. Resolving any pending disputes that may exist. These can be with a payer, a vendor, or an employee. Reviewing current compliance practices and identifying any current compliance issues. All these things we'll want to have an understanding of before we begin the actual deal exploration process. On the next slide, we'll discuss those first legal steps. Once the parties are ready to begin the actual formal discussions, a non-disclosure agreement should be put in place. This should be a balanced agreement that applies to both parties. Typically, both parties will be sharing information on the other. We'll discuss that more here in a moment. There doesn't need to be a significant amount of time or energy spent in negotiating these documents, but there are a few points that should be noted. Again, it should be fairly balanced. It will discuss the obligations of the parties during this negotiation. It should apply to them equally. Oftentimes you'll see a non-solicitation provision built in. That's appropriate. There will often be a venue provision where a dispute will be handled. We try to at least put that in the seller's court or venue, or at least not at all, to make it as neutral as possible. There may be other bells and whistles to be included depending upon the party that you're negotiating with. For example, if the potential investor is a current or soon-to-be competitor, that's a consideration when negotiating these documents. On the next slide, we'll go ahead and discuss letters of intent. If discussions go well, the next step is the actual negotiation of an LOI. The LOI won't be the binding document with all the terms, but it definitely should include those essential to the deal. Typically, those terms include whether the transaction will be a stock purchase versus an asset purchase, the purchase price and how the purchase price will be calculated or adjusted at the time of closing, whether the purchase price will be cash or rollover stock or a combination of the two, any rights the investor will have to recover a portion of the purchase price and the terms for any amount to be held in escrow, material terms of any expected post-closing employment or consulting agreement or role, the duration and scope of the non-competes that the investor is going to require, having the closing date identified, the duration of any standstill or no shop provision under which the seller will agree not to enter into negotiations with any other party. And then lastly, sometimes a termination fee or transaction fee will be built into the document so that if an ultimate transaction is not closed, then the party to which it has the fault has to pay the other party a termination fee. On the next slide, we'll discuss what the due diligence process looks like. As Abe acknowledged, this is an intense process. There are two aspects of the due diligence process. The first and the bulk of it will be on the part of the investor. As mentioned, this will involve a request from the investor for all corporate documents, all material agreements, tax returns and financial statements for a period of time, and information and documents related to regulatory compliance. During the process, healthcare regulatory lawyers, medical coders, and other consultants will be brought in to assist the investor in its review. So expect to be working with a variety of individuals. The investor will set up a data room where all these materials will be uploaded, and to ensure that the information is secure, we want to make sure that data room is the location where we share the requested information. It's also the most efficient way to manage the flow of requested information, and not just sending separate emails with responses to requested information. This is definitely where the preparation will pay off. Keep in mind that all this information shared will need to be easily located later, as Abe mentioned, when preparing the schedules that will be required for an ultimate definitive agreement. And this due diligence and the schedule preparation is the hardest and most intense part of any transaction. This means the most resources, outside support, scrutiny, and the more you do this upfront and in an organized way, the more efficient and least costly it will be as you proceed through this process. On the next slide, we'll discuss the seller's due diligence. Now, as Abe laid out, there's a lot of questions that the seller needs to be asking itself as to why it wants to do a deal, what it's looking for in a potential investor. And again, as Abe said, unless this is a public investor or buyer, the likelihood is that the seller is going to continue to be involved in the business after the investment. And that means the seller's due diligence process could be just as valuable to the seller as the actual purchase price. This is going to allow the seller to confirm there's compatibility with the investor, and that the investor is likely to deliver on all those expectations that Abe walked you guys through, that you'll need to identify before pursuing a deal. The issues we typically recommend covering include the investor's corporate culture, speaking with other physicians who have entered into a deal with an investor, inquiring as to regulatory investigations or fraud and abuse litigation, how the investor plans to reach its profitability goals, obtaining information on the investor's expertise in this sector, its expansion plans, and its success to date. All right, now moving on to due diligence process and issues. We'll take a deeper dive into what the seller should expect during the investor's due diligence process. Most often, the investor starts with reviewing the financial information to confirm the seller's earnings. This is often done even before the LOI is, of course, finalized. It's soon after the NDA is signed. This will include the financial statements, coding audits, compensation methodology, and sources of revenue that they'll need to review. The investor will then review material contracts like payer agreements, employment agreements, leases, loans, software licensing agreements, the significant contracts that the business relies upon. The investor's looking to confirm a few things. Most importantly, are the agreements still in effect, or did they expire and are no longer technically in effect? What are the financial terms? When do they expire? Do they expire in 30 days? Do they expire in 5 years? How they can be terminated, if there's an exclusivity or non-compete provision, what happens, what's required in the event of change of control, is there just notice or is there consent? Next, the investor will want to know of past and present investigations, disputes, settlements, and current liabilities, such as loans, letters of credit, tax liabilities. And lastly, the investor will want to understand how well the business is doing in the area, specifically of healthcare regulatory compliance. As Abe noted, this is a heavily regulated space. It is on the radar. Pain is subject to even more regulations than other healthcare businesses. Again, as Abe mentioned, an attractive business opportunity, but closely being monitored. The result of this due diligence process can include cleanup requirements that the investor imposes on the seller, could impact the purchase price if they find some surprises or issues that need to be addressed that are material, could result in amounts that need to be escrowed until the investor gets comfortable but that the issue has been resolved. And it could impact the timing for closing. Now, on the next slide, we'll start reviewing some of these regulatory issues more closely. Depending upon the laws of a particular state, the investor may not be able to directly own an interest in a business engaged in the practice of medicine. These are what we call corporate practice states, where investors are required to use a friendly PC model, where a friendly physician serves as the owner of the practice. Typically, that friendly physician is one of the senior or principal physician investors or owners of the seller, and also the use of a long-term, very robust management agreement between that friendly PC and the investor's management company. There are regulatory issues, state regulatory issues, that will also impact how that management agreement is structured. The management fee in particular is structured, whether it's a fixed management fee or a percentage-based management fee. And to the extent that the seller currently has non-physician owners in its model or utilizes that management model I described, the investor will assess compliance with these same issues. Moving on to the next slide to continue the review of healthcare regulatory issues. These are going to be of greatest concern to the investor of all the issues that are reviewed in the transaction. Going back to the home buying analogy I provided, this is the equivalent to checking for termites. The investor will review the information disclosed to confirm compliance with the various healthcare regulatory requirements. And just because, I hate to use it and continue with that analogy, just because you find termites doesn't mean they don't want to buy the house. There may just need to be some corrective actions taken around those particular issues. This will apply to the fraud and abuse and billing and coding aspects of the business. With respect to licensure, the investor will need to confirm that each aspect of the business is properly licensed. This will include confirming that all licenses are current, when they expire, and that they're accurate. Unfortunately, sometimes practices change locations and forget to update the license with the new practice location, or have a change in personnel and forget to change the managing officer or the physician that might be connected to a particular license. On the privacy and security side, they'll be looking to see if there's HIPAA compliance in the form of a compliance plan that will include a notice of privacy practice and consent for patients and authorizations of patients. And then lastly, take an inventory of the business associate agreements that are in place. Moving on to the next slide. The fraud and abuse laws generally are intended to prohibit paying a kickback for making a referral. And we've got a few specific laws that fall under that category. First, the Stark Law specifically applies to physicians and their immediate family members who make referrals to entities that they have a financial relationship with for designated health services. Financial relationship is a very broad term. It's ownership in any contractual relationship. Designated health services, at least just for our call today, will say are services that are billed to Medicare. That will trigger the Stark Law applicability. We've got the federal anti-kickback statute, which is completely separate and applies to everybody, not just physicians, and doesn't just apply to designated health services. It applies to federally funded program services. So we have a similar concept on the prohibition of a kickback for referral. There are exceptions and safe harbors that make it possible to have these relationships if structured within those safe harbors and exceptions. Many states have their equivalent of a Stark Law or any kickback statute that may apply to commercial services or even self-pay services. Moving on to the next slide, we'll touch on some of the specific regulatory areas that will be reviewed more closely. These areas are where the investor will want to make sure they're comfortable. First, how the practice calculates amounts paid to physicians and other providers. They want to make sure it's consistent with the fraud and abuse requirements. Is it consistent with what's actually documented in the agreements? Is it paid in the form of compensation, or is it paid in the form of distribution based on ownership? Are cost centers used for allocating some or all of the revenue, or is there some other methodology for calculating amounts paid to providers? Next, are the medical directorships, consulting agreements, leases, and marketing agreements, and whether they're properly documented and what their specific terms include? For example, do they meet the exception and safe harbor requirements for being with for a period greater than at least 1 year and consistent with fair market value? Of course, no business is perfect and issues are likely to be identified. An investor needs to understand what they'll be potentially inheriting in terms of risk. So this is just an information gathering process and not intended to be a deal killer or jeopardizing a deal process. It's going to give both parties the chance to correct deficiencies. It may include some self-disclosure steps, but also making improvements going forward. Okay, moving on to the next slide. We'll take the same approach with billing and coding practices. This, again, is of particular focus in the pain space where there's been concern over proper prescribing practices. Also relevant will be the use of and billing for mid-level providers. Again, no practice is perfect. There's going to be some issues identified. Most of the time, there are issues that can be addressed. Next will be requirements around a change in ownership that will result from the investment. The investor will review all the licenses to determine which require notice of a change before the transaction, which ones may require notice within a certain period of time after the transaction. Some licenses and some states have a pre-clearance process, which can be comforting to get ahead of time. But all these issues have the potential of impacting the time of closing. Lastly, depending on the structure of the transaction, a new Medicare provider number or EIN may be required. This will happen when moving the business to a newly formed entity. This will be, of course, a time-consuming process and can also impact when closing occurs. Moving on to the next slide, let me close by highlighting some of the more healthcare-specific deal terms. The seller will be required to make a variety of representations and warranties with respect to the business. It's standard for the seller to try and limit its representations in a number of ways. Investors typically are willing to make some accommodations. Often they'll carve out what are referred to as fundamental reps. These at a minimum will include representations around regulatory compliance, and I'll touch on where these come into play further in a moment. If closing will not take place simultaneously with signing, what we call a two-step process, a sign and then close, then there'll be some conditions that'll be laid out as conditions to close. To avoid just being in limbo with those conditions pending, we often will build in a termination right if some of those conditions don't happen within a certain period of time, to allow the parties, or at least the seller, to get out of the transaction. Indemnification obligations are standard, but typically they too are negotiated. They're often negotiated so as not to arise until a certain dollar value has been met. These are often referred to as baskets or deductibles, and are in fact very similar to how a health insurance deductible works. They can range in amounts. It really comes down to the deal size. They can range from $25,000 basket to a $250,000 basket. The total indemnification obligation is also something that's negotiated, as well as the time period. For example, on the time period, we'll try to get something as low as 18 months, but not to exceed 36 months in that negotiating process. We'll also try to limit the total indemnification obligation so it doesn't exceed the purchase price amount. However, in this negotiating process, while investors often will agree to these recommended changes, they will push back hard and often do not give on those fundamental reps that I referenced earlier. So they will say those limitations with respect to the time period and the dollar amount will not apply to claims related to fundamental representations. With that, I will now turn it back over to Provident for Q&As.
At this time, we'd like to open it up to questions. You can find the Q&A box in the control panel, which is likely located at the top or bottom of your screen, and feel free to type the questions in there and the panelists will address them.
And so I see we have our first question here. So what are the risks and benefits of joining a private equity platform compared to joining an established private equity-backed business? So what they're asking, what are the risks and benefits of raising private equity capital ourselves as an organization compared to joining somebody like a National Spine and Pain or Clearway Pain Solutions or someone like that? So I would say first, with respect, it's all kind of a risk and cost benefit trade-off, right? So if you are the platform, everything is built off of your organization. So from a culture standpoint, you tend to have the most autonomy under that model, obviously, because it's private equity firms are professional investors. They're not interested really in getting involved in the hands-on nitty-gritty operations of the business. So everything's being built off of your organization. If you were to join an established platform, let's say you join National Spine and Pain Centers or another group like that, they kind of have their way that they've built up that they do things. And so if you join that organization, you're joining it because you believe in the way that they do things and want to be a part of that. So it's a little different in that regard. I think from an economic standpoint, you tend to maintain a larger percentage of equity in initial private equity transactions. So probably on average in a platform private equity deal, the groups will roll probably 30% of the equity. So private equity firm will buy 70%, the organization will maintain about 30%, maybe 40%. I would say, generally, if you're joining an established group, probably going to roll a little bit less. So, maybe 20%, 15, 20%, and that's an economic difference. I think conceptually, the way to think about it from a risk standpoint, if you join someone where you can already have seen how they've grown since doing their first private equity deal, you can see the types of things that they've put in place. You can get a better feel for how what their strategy would be in partnering with your group, and so there's a little more certainty to that, to that type of transaction. Whereas if you were to partner with a new private equity firm, say, Fraser Healthcare Partners from the presentation, Fraser has a style that they'll leverage, from their other experience with other, multi-site clinic-based physician service businesses, but at the same time, it's still their first paying investment, and so they'll be building that strategy along the way. So it's a little different because you'll be more integral in kind of the build out versus somebody who's already done it.
Abe, I've got a question here that I think I can knock out quickly. Are non-competes actually enforceable? Well, there are two types of non-competes. One that's associated with the equity that someone may receive related to the transactions we've described. And the second type of non-compete would be one that's found in an employment agreement. Each state is different when it comes to enforceability of non-competes. They are disfavored in most states. Texas has an actual physician non-compete statute, which makes them enforceable so long as certain requirements are met. And that's really on the employment side. And same for California. California highly disfavors non-competes and only allows them related to some kind of acquisition. But generally, there is likelihood of some degree of enforceability around non-competes.
And here's another question. What is the ratio of seller targets that are already on an ACOS model or fee for value versus still on a fee per service or fee for service model? That's a good question. It's mixed. So we've certainly done transactions where there's the majority of the transactions that are being done are fee for service. But there are certainly deals being done with groups that are on capitated payment models or fee for value models. Typically in markets, where there tends to be large ACOs or large integrated systems like Southern California or some other markets out there like New York. But generally, the majority are fee for service. But it's becoming a larger part of a lot of transactions we do, and we're seeing more activity with some of the value-based care kind of contracting groups. But certainly, the majority are fee for service. And I know we're kind of running out of time here. One final question we just got. What's the most important thing we can do prior to a transaction or prior to preparing for a transaction? So I think Hal and I both touched on that. It really comes down to education and preparation. So making sure you have your kind of ducks in a row, making sure you understand things like why you want to pursue a transaction, having your shareholders and stakeholders on board or understanding at least why you're thinking about pursuing a transaction is all very important.
That's actually all the time we have for today. If anyone has any additional questions, please feel free to reach out to either of the presenters. Their information is right on the screen. Thank you so much for joining. We appreciate everyone's time. Enjoy the rest of your day.